Michael Woolfolk joins us now. He's a senior currency strategist at BNY Mellon. He's live with us from downtown Manhattan. So really, Michael, the story overnight really seemed to be about yen strength, this fear that the end of the world was afoot with this figure we got this morning. What's the story now? How's the narrative changed?
Well, certainly ahead of Friday's revision to second quarter GDP, the market has been anticipating some negative news, and we've had a string of negative news this morning, really feeding into the negative attitude of the market. We have a trifecta, if you will, of negative North American data. Not only did existing home sales disappoint out of the U.S., but earlier this morning, Canada released its retail sales report, which was worse than expected with negative historical revisions, and Mexico released a larger than expected trade deficit also this morning. So this news has fed into buying of yen and dollars temporarily, but we saw kind of a buy the rumor, sell the fact. Some technical objectives were achieved below 84 in dollar yen and below 126 in the euro dollar, and so now we're seeing some profit taking set in, and which is likely to probably persist for the remainder of the afternoon.
Yeah, we're at 126.96 on euro dollar right now. That yen overnight was at a 15-year high against the U.S. dollar. I mean, does the story stay the same through Friday and those expectations of GDP revision?
Well, first of all, I think you have to be very careful of looking at dollar yen as a 15-year low. Certainly, nominally speaking, we're at the same level as we were 15 years ago at 85 in dollar yen. But because of the differences of inflation between Japan and the U.S., the yen is actually depreciated in real terms 32%. So it's not nearly as strong as we think it is. It can decline further. Expectations of the market is for renewed dollar buying, yen buying, and to a lesser degree Swiss buying ahead of the Friday revision to second quarter GDP. After that, you'll probably see again a kind of a similar reaction as we had today, with some profit taking and another bounce going into the weekend.
We also saw some concern around the sterling, as we heard in the UK that a double dip definitely a possibility on that front. What are you forecasting?
Well, I think the closest we're going to get to a double dip, either this side of the Atlantic or the other side of the Atlantic, is maybe this summer the ice cream truck out store outside of.
Well done.
It's not going to happen. Certainly, weaker growth is. We're not only experiencing it, we're likely to experience it in the second half of the year, but we're going to be a far cry from negative GDP territory. Expect to see over the course of the fall, Margaret, politicians here in the United States and in England step up efforts to try to stimulate the economy. And with that, I think quantitative easing is going to be something that's going to be hotly debated.
What do you mean by that, though, efforts to stimulate the economy? What by QE do you mean?
Well, specifically, we have many of our central bankers and foreign officials in Jackson Hole, Wyoming, at the symposium sponsored by the Kansas City Fed, discussing this very topic about monetary policy for the next decade. It's a debate that's raging right now as to whether zero interest rates is appropriate. Right. I think that what's more likely is that buying of own government bonds, U.S. Treasuries here in the States, gilts in England, is going to be a far more likely scenario.
So the $2 trillion just a starting point.
That's correct.
All right, correct. Michael, thank you for joining us, giving us perspective on a busy morning. Appreciate it.
Thank you.